Both stocks and bonds posted strong returns to finish 2023, although after such a strong rally, it does leave valuations looking slightly stretched in some assets. Our base case is still for a soft landing in the US, but this is now very much reflected in the level of equities, the tightness of credit spreads, and the extent to which government bonds have moved to price quite significant central bank rate cuts this year. The pack of cards needs to be reshuffled to provide fresh opportunities. The challenge, of course, is that markets can move quite quickly, with elections in 40 countries this year, a tense geopolitical environment, and central banks are in the middle of landing the economy, which can always create volatility. We don't think the US will move into recession until the end of 2024, and with cash rates starting to fall, would encourage people to stay invested. But you need to be flexible to navigate these markets and take advantage of buying opportunities as they arise. Once again, the market is itching for a pivot from the Federal Reserve in the US. We think this pricing looks a little aggressive against a backdrop of high levels of employment. Although inflation continues to move in the right direction and wage growth has peaked, it feels premature for the Fed to cut so aggressively. If the Fed were to choose to emphasize falling inflation rather than tight employment conditions, then we would view this as being more bullish for equities than for bonds, because we still view the risk of an imminent recession in the US as being low. More broadly, and in the context of the 3D reset and the work we've done on the medium-term implications of demographics, deglobalization, and decarbonisation, the next task is to really think about what policies emerge from the differing hands of cards that the policymakers have been dealt in different countries. Historically, the US has been able to run a more stimulative policy owing to the dollar's reserve currency status. As Reagan once said, "I'm not worried about the deficit, it's big enough to take care of itself." But a Trump victory might push the patience of investors too far if it resulted in more fiscal profligacy. Europe has a growth problem given aging demographics and higher energy costs than its competitors, but it also has a relatively stable political system and its conservative fiscal policies are supportive of European bonds. Japan is still running stimulative policies because of its deflationary past and its high level of government debt might be an obstacle to tightening. That's good for growth. China faces a deflationary environment as it copes with the ramifications of its property crisis, and although we see some upside to the export cycle, it cannot rely on mercantilism given the size of its economy and the protectionist backlash in the West. So the stage seems set for greater regional divergence over the next couple of years.